From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli. Well, not a great session on the local market today, and that is, of course, as we had that very strong jobs data really just pairing some of those bets in terms of how fast these rate cuts will be from the RBA. Some commentary out there that will they actually be forced to hike? But of course, that is just a question, and I am certainly not an economist, just reiterating what I've read out there. Let's have a quick look at where the market is tracking when we see that weakness in terms of the overall market. We are down by 1.2% there on the CBO 200. The ASX 200 is down by 1.25% or 106 points. 8,313 points is where we're at the moment on the overall market. Let's have a quick look as well at some of those thematics that we saw as well, because it really has been about this Thursday tumble, weakness coming through in the markets as we really start to reprice what's going to happen in terms of rate moves, and of course a lot of geopolitical concerns as well. We had President Trump saying overnight that he intends to impose auto tariffs in the neighbourhood of 25%. You've got these concerns as well, particularly about whether or not there's going to be a big kickoff in terms of a trade war between Europe and the United States. A lot of those tariff players tumbling in the European session. Unemployment uptick, look, it did go up to 4.1%, but it was a record participation rate. So the amount of people looking for jobs, the highest on record, and a lot of females are returning to the workforce at the start of the new year, really lifting that overall jobs number. 44,000 jobs created versus expectations of 20,000. 54,000 of those were full-time jobs. There was a decline in part-time jobs, which of course is always seasonal. Those workers that picked up particularly retail work in December over the Christmas period, those jobs I should say, coming out of the labour market. And then the Aussie stabilising, really interesting conversation I had just after the jobs data was released with Nick Twidale from ATFX. That was the trade. You can find that of course online, ausbiz.com.au. Remember, just a couple of months ago, there was these concerns that Aussie could fall through 60 cents. It seems to be very much more stabilising towards that 63.6 cent level, 63.5 cent level. And Nick Twidale saying, look, 65 looks a lot more of a reasonable potential test for the Aussie than falling back the other way. Let's have a look at the sectoral moves today, kicking it off with the weakness that we saw once again in banking stocks. CBA down 2%, NAB off 4%, ANZ down by 3%. The miners as well, of course, we had Fortescue coming through with numbers. Weak iron ore prices very much impacting Fortescue. Shares down 6%. BHP and Rio also coming under pressure. And of course, Telstra, Andrew just had a chat there to the CFO. Had a chat myself with Henry Jennings earlier today. He calls Telstra tech in a cardi and says boring is good when it comes to reporting season. Telstra shares rising by more than 6% after lifting its dividend and announcing a $750 million share buyback. Superloop also reporting. We'll be speaking to them tomorrow. Let's have a look at some of the other stories in detail. We touched on Rio there. Now it reported its smallest full-year underlying profit in 5 years, $10.9 billion US dollars. Aristocrat also on your screen there. Aristocrat buying back $750 million worth of shares. Pilbara also came through with an update today, as well as Sonic Healthcare. And we've got Aristocrat there twice. All right, let's have a quick look now at what we are seeing from our guest, Mathan Somasundaram from Deep Data Analytics, joining me. Welcome to the COB, Mathan. Your thoughts really on this sell-off, I guess, that we saw on the market today?
Yeah, that's 4 days in a row that we've been negative. That's not very common. So the reporting season overall has been okay, but I think the market had, I mean, as you would expect, we're trading, on a global basis. The market cap's way too high, so extreme multiples. So any kind of disappointments, we've seen some serious volatility. And the interesting part is we're seeing it in the big caps, and that's dominated by global funds getting in and out. So there's a lot of global funds getting out with weaker than expected results in the big caps.
Yeah, and that's obviously what does cause a lot of the selling. But also, you've got to really look at the banks, Nathan. I mean, everybody was sort of saying CBA particularly overvalued. Then it came through with its numbers, hit another record. But the last 4 or 5 sessions, the big banks have tumbled quite significantly.
Yeah, global banks are only defending CBA because that's the big cap. And the others have, I mean, the banks are way overvalued in the context that everyone knows you don't have to be a bank analyst. The Combank is giving you sub 4% dividend yield, has no growth, and that's the best of the lot. So you can only imagine how the others are going. So in that context, it's probably overvalued 30-40%. So that's there because the global funds can use the banks because they're liquid, they're big, you can get in and out, you can manipulate the market. So it's a perfect candidate. So in that context, no domestic buyer is buying the banks. It's all the global guys buying and selling. So in that context, you come out with a weak result. We saw that with Bendigo Bank. That led the bad banks. It was down, 16-17% on the result. And then you had Westpac, NAB, ANZ. You've just been hammered through that. The reality is the Combank has very little growth. And that's part of that is they were able to squeeze even higher margins and at a time when they're reducing their bad debt provision. RBA is not cutting rates because bad debt is in a better shape. They're cutting rates because they're worried. I think that's wrong. It was wrong, and they'll probably regret it in about 6 months, like what the Fed did. But let's look at it through the numbers. The banks were overvalued. They're coming off. No one's surprised. I don't think it's a buying opportunity. I think there's a lot more downside to the banks.
Wait, so you're saying you think the RBA will think that 25 basis point cut, which really doesn't do much for the average mortgage holder, is going to have been a mistake, and then maybe they'll have to reverse course?
Yeah, they will. I mean, the Fed did. ECB is already thinking about it, holding. And then you look at the BOJ, and BOJ potentially is going to be hiking multiple times. So there's a lot of, I guess, we did forward buying of growth to keep the economy is going for longer. We haven't made any structural changes. I mean, you can look around the world, how many people have done actual policy to drive structural change? Very little. So all we've done is we've done more of the same thing. And so now that's running out of fuel. So I think RBA does maybe one more cut and then starts to talk about maybe we've gone too far, let's go hold. And that's what the Fed did. And I suspect RBA will do the same.
I hope you're wrong, Nathan, but anyway, nobody cares about me and my mortgage. Let's talk about Trumponomics and tariffs. Certainly a lot of concern here about a potential trade war with Europe unsettling investor sentiment overnight.
Oh, look, it's inevitable, right? They've got a tax plan that has to go through that's going to cost $4.5 trillion. We're talking trillions here. They've got Dodge running around claiming to have cut a lot of savings. At best 100 billion, it's a rounding error. Most of it, I don't think it even is realistic because if there was so much fraud, how come not a single person has been charged? So I don't think those cuts are real. And I think everyone knows that. The Republicans are asking for the debt ceiling to be raised by 4 trillion. So the reality is the numbers suggest that debt is going to grow dramatically. Deficit is already growing. And we're talking about we were pretty close to extreme debt and deficit, and we're going to go higher. So in that scenario, I don't think tariff was an option. They have to do it because they have to show that they've got some revenue coming in. So EU, they've already created the interactions that are going to support the tariffs. So that's a given. The interesting part is what's happening with China. China is given up trying to play ball. They're just doing their thing. And interestingly, the Chinese techs are now, over the last 2.5 years, the Chinese techs are outperforming the US NASDAQ. That's an amazing turnaround that nobody is talking about. Everyone talks about the AI and the whole NASDAQ dominating it, but the Chinese techs have come hard. And I suspect that that's going to continue. So the question is going to be where to from here. I think we're just going to see regular announcements, backtracking, delaying. It's just going to be one of those things. It's going to be a reality show. So you just have to ignore that and stick to the fundamentals. The fundamentals is all the countries are in a serious debt problem, and that's going to keep going, just like what RBA did. They cut rates and bond yields went up, just like what happened with the Fed. So the debt problem is real. that's not going to be unwound. So we just got to play that cycle, and everything else is just reality TV stuff.
So what does that mean then for consumer confidence, for the consumer in general? I'm about to speak to the Wesfarmers CEO. He mentioned, concern about looking ahead, not only geopolitics that you've touched on, but of course whether or not consumers are going to pull back from spending. And of course we saw super retail's numbers today as well.
Mm-hmm. Yeah, you're bang on. Wesfarmers is probably the most defensive and probably the high quality retailer. And when they're worried, everyone else should be worried. We've seen downgrades from the better performing retailers. Premier had the downgrade, Lovisa had the downgrade. Now Super Retail. These are all top performing retailers, and they're having downgrades. So you can only assume we're probably close to the cycle, and historical trend is pretty obvious. When RBA is hiking rates, people are spending too much. You buy retail stocks. When RBA is cutting rates, then RBA is telling you people are not going to spend that much. So guess what? RBA just started cutting rates. It used to be reducing cyclical stocks like retail.
All right, Mathan, always a pleasure. Have a great rest of your day. Mathan Somasundaram from Deep Data Analytics there with us. And speaking of some of those retail players, we actually had a really interesting stocks of the day on the call today, comparing Super Retail in contrast with Universal Store. And Nadine was joined by Howard Coleman from Team Invest and Grady Wolf from Bell Direct.
Universal, on the other hand, very keen on it. They target the younger demographic. So you're looking at the TikTokers, the Instagrammers who need all these Sambas and Adidas and the latest shoes every week. And they don't have cost of living pressures. So they have this area of their life. They don't pay rent. They don't buy their own food. They have their first retail job and they spend all their money back in that job. The Universal Group increased their dividend by 33% to 22 cents per share. We don't often see a strong dividend in the retail space, so that's really good that they did that.
Looking at the actual companies, I've actually owned a small amount of Super Retail Group for many years. Pays very high dividends. My total shareholder return since I've owned Super Retail has been terrific, but I've bought it each time only when there's been disaster in the market. During the GFC, during the Greek debt crisis, during COVID. During COVID, I think its share price went down to about $5 or something. I may be slightly out, but it was something in that range. And I bought a whole lot extra during COVID. When it got to the $15 and $16 level, its PE was high for a retailer. It wasn't the time you'd be buying.
All right, let's have a look at the market leaders on a very heavy day of selling. Nanosonics, it came through with earnings today, rising 24%. The Reject Shop also higher by an impressive 19%. Megaport was out with numbers too, up 18%, as was Whitehaven Coal, which came through with an earnings update, rising 9.25%. To the downside though, and there were plenty of those. We mentioned Super Retail. Magellan also through with an update today, falling by 11%. Coronado, Johnsling and Ordinate. Looking at the small end of town, and the Reject Shop is there twice, leading the pack there, up 19%. Arafura Rare Earths had a good gain of more than 9%, heading the other way in the small end of town. Northern Minerals, some of the lithium players, Orthocell also weaker by 7.3%. A little bit out overnight tonight, including the European Commission's Consumer Confidence Index, the Philadelphia Fed Manufacturing Survey, weekly jobless claims in the US. Quite a few FOMC members speaking, including Austin Goolsbee, and we have earnings, not warnings, but maybe it will be a warning, from the big retailer Walmart. Tomorrow, locally, Friday, normally quite quiet, but we do get the manufacturing and services PMI data. Governor Bullock will also speak. Of course, she just fronted the media a couple of days ago, probably likely to issue more of a cautious stance about mortgage holders, expecting any further rate cuts imminently. We also get the Kiwi trade balance and another busy day of earnings, including Block, QBE and Guzman y Gomez. And we'll be speaking to Guzman y Gomez tomorrow. We'll bring you that interview, 3 p.m. show. Maybe grab a burrito and join us for that. But let's have a quick look at where the market has finished, down by 1.2% on The CBO 200, the ASX 200 falling by more than 100 points. Nope, it's just fallen by 96 points on the close, 1.15%. 8,322, a new 20-day low. Super retail, we touched on Magellan, the weakest performers, and really only upside today from telcos, led by that impressive jump from Telstra, energy and industrial players, but big falls coming through from the healthcare stocks, from the financials, from the material players. All right, we do it all again tomorrow from 9:45 a.m. Eastern. Have a good evening and we'll see you then.